Hi, I'm Brian Barrows, a wealth advisor with BSV CPAs and Wealth Advisors. Today, I want to talk about an exciting new savings opportunity that many families have heard about or will start hearing about over the next year: Trump accounts. These accounts were created under federal law in 2025 and are expected to become available starting July 2026. They're designed to help families start saving and investing for children early in life, essentially giving the next generation a head start financially. In many ways, you can think of them as starter retirement accounts for kids. Let's walk through what they are, who qualifies, and how they work. A Trump account is essentially a traditional IRA created for a child. The account is owned by the child, but it's managed by an adult, typically a parent or guardian, until the child turns 18. So the structure is similar to other custodial accounts. The key idea behind the program is simple. Start investing early in a child's life, allow the money to grow over time, and give young adults a stronger financial foundation when they reach adulthood. Once the child turns 18, the account transitions into a traditional IRA, and standard IRA rules begin to apply. One of the most talked about features of Trump accounts is the initial government contribution. Under the current pilot program, the U.S. Treasury plans to deposit $1,000 into the account of eligible children. The contribution is available for U.S. citizen children born between January 1st, 2025 and December 31st, 2028, as long as the parent or guardian elects to open the account and the child has a Social Security number. The goal is to give every child in that group an investment account from the very beginning of life. Let's talk about who's eligible. So in general, any child under the age of 18 with a Social Security number can have a Trump account. However, the $1,000 government seed contribution only applies to children born within that 2025 to 2028 window. Each child is limited to one funded Trump account. Let me say that again. Each child is limited to one funded Trump account. The kickoff date is July 5th, 2026, and is initiated by filing Form 4547. Let's talk about contributions. One interesting feature of Trump accounts is that multiple sources can contribute. Funding can come from parents or family members. Parents or family members may contribute up to $5,000 per year. Employers can also contribute up to $2,500 per year to the Trump accounts of employees' dependent children. These contributions are excludable from the employee's gross income if made pursuant to a program that meets certain conditions. This tax exclusion also applies to employer contributions to accounts of employees who are under 18. The $2,500 limit on employer contributions that are non-taxable to the employee is an annual limit that applies per employee, regardless of how many dependent children the employee has. Each of these contribution sources may have slightly different tax treatment, but the concept is that the child's investment account can grow from multiple contributions over time. Remember, a $5,000 limit exists per year, per child, regardless of who is funding the account. One unique difference compared to a custodial Roth IRA is that earned income is not required for contributions. That means families can start saving even before a child has a job. Let's review the investment policy inside the Trump account. So right now, the language is somewhat broad, but indicates the account must be invested in low-cost index or mutual funds or ETFs that track broad market indexes. These investments are capped at a very low expense ratio, around 0.1 or 0.1% or less. So the goal here is to keep the investment strategy simple and low cost. So we like that. Withdrawal rules. So another key feature of how the withdrawals work, in most cases, Funds cannot be withdrawn before the child reaches 18, which in my opinion is a good thing. We're encouraging saving for retirement. And after that point, the account essentially follows traditional IRA rules, meaning withdrawals would generally be taxed as ordinary income plus a 10% penalty prior to age 59 and a half. Let's walk through a quick scenario for Susie Smith. So Susie Smith's parents, Sam and Sally, deposited $5,000 into the Trump account each year for 18 years. With the $1,000 initial bonus, the Smith's total investment is $91,000 over 18 years. At a very achievable 7% hypothetical rate of return, the account is now worth roughly $184,000. Wait, that's not the end of the scenario. Because Susie Smith just graduated from high school or college at some point, she has most likely a low income relative to what we might project for the rest of her career. And because the Smiths are clients of BSV CPAs and wealth advisors, their lead advisor recommends that Susie consider executing a Roth conversion strategy to take advantage of her low tax bracket and tax-free compounding growth in her Roth IRA. Susie never contributed another dollar to her Roth IRA, but it compounded from age 22 to age 62 at a rate of 7%, and now she has approximately $2.75 million in her Roth IRA after 40 years. That is so exciting. So it's so important to remember that the Trump accounts are not the only way to save for children. We've got 529 college savings plans, taxable custodial accounts, custodial Roth IRAs with earned income for the children, and Trump accounts just simply add another tool on the tool belt. So depending on your goals, whether it's education, savings, retirement, general investing, these accounts could potentially complement existing strategies. And Trump accounts are still relatively new program, and some implementation details are still being finalized, but the basic idea is straightforward: to start investing early and to give children a financial head start and allow long-term compounding to work over time. So if you have children or grandchildren who may qualify, this is definitely a topic worth discussing. I hope you enjoyed the short video. If you have any questions or would like to talk about how this may impact your family, please reach out. Thank you for watching, and we look forward to seeing you soon.
The BSV Wealth Podcast is hosted by Brian Barrows. BSV CPAs and Wealth Advisors does not offer, or intend to offer, personalized financial advice through the BSV Wealth Podcast. The information provided is for informational purposes only and does not constitute tax, accounting, investing, legal, or financial advice. The podcast is produced by Brian Barrows, a certified financial planner and wealth advisor at BSV CPAs and Wealth Advisors. Securities are offered through Cetera Wealth Services, LLC. Member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. Insurance offered through a Cetera affiliated insurance agency.